All right, welcome in everyone to the deep dive. We're diving into portfolio optimization today. You guys sent in some really fascinating stuff, and we've boiled it down to this really critical question. How is technology, especially GPUs, changing this, really fundamental part of finance? And it seems like you wanted to get up to speed really quickly, but, without skipping over the important details. So that's exactly what we're going to do today.
Yeah, spot on. So our main source is a presentation from GTC 2025. That's the GPU Technology Conference. The title was Accelerated Portfolio Optimization. There's a really impressive lineup. Iona Boyer and Chris Melfi's from NVIDIA, Pei-An Hu from Cornell, and then Yigal Shirad from Cohen and Steers. And then we also have some great audio from that event. They had a panel discussion with these experts and Flora Huang, also from NVIDIA.
So as always, the goal is for you to walk away with clear understanding. We're going to look at how portfolio optimization has evolved, the essential math behind it all, the real-world issues that, people who do this every day are dealing with, and then, of course, this really game-changing impact of GPU-accelerated computing. So to get started, where did this idea of systematically optimizing a portfolio even come from?
Well, the story really goes back quite a ways. You have early thinkers like Benjamin Graham. His book, The Intelligent Investor, came out back in 1949, and he was a big proponent of value investing. So really focused on looking at individual companies, doing that bottom-up analysis to see if their stock was undervalued.
Hmm.
So he sort of set the stage for a lot of the modern thinking, a shift towards really considering risk instead of just speculation.
Yeah, a really fundamental change in how people thought about investing. And then wasn't there a big leap forward with Harry Markowitz in 1952?
Yeah, absolutely. So Markovitz, he basically gave us the framework for understanding risk and return. His big contribution was that it's not enough to just look at the potential returns of individual investments. You have to consider how those investments behave together in a portfolio. And that was the birth of what we now call modern portfolio theory. And that risk-return perspective is still absolutely central to everything in portfolio management.
So it wasn't just about picking winners, it was about how those winners interact.
Exactly. And of course, things haven't stood still since then. You have newer approaches like hierarchical risk parity that was developed by Lopez de Prado in 2016. And then there's reinforcement learning, which has been applied to portfolio management since like the late 90s and is definitely a hot area right now.
Applying reinforcement learning to trading, man, that sounds like a whole other deep dive right there.
Oh, for sure. And actually, if you are interested in hierarchical risk parity, we've got a blog post on that, on how to speed those calculations up using GPUs. But for today, yeah, we're going to focus on that core risk-return framework that Markowitz started.
All right, so we've got that historical context. Now, where does portfolio optimization actually fit in, practically speaking? I mean, it's more than just deciding the final mix of assets in a portfolio, right?
You're right, yeah. Optimization shows up in different parts of the trading workflow, like firms use it to calibrate their market data and even for execution optimization. So, figuring out the best way to execute a large trade, splitting it into smaller orders to minimize costs and the impact on the market.
Right, makes sense. You don't want to move the market against yourself just by trading.
Exactly. But for today's deep dive, yeah, we're mainly looking at asset allocation. So taking those alpha signals, those are predictions about which assets might do well, and using them along with your predictive models to determine how much of each asset you want in your portfolio.
So the models tell you what might happen, and optimization helps you decide how much to bet on each possibility, given your risk tolerance.
Right. And that output, the target allocation, it feeds into other processes downstream,
Yeah.
like strategy simulation, which is where you test how your portfolio would have performed in different market conditions.
So the better the optimization, the more reliable those later steps will be.
Absolutely. And there's this whole ecosystem of NVIDIA technologies working in this broader trading workflow.
Mm.
So you have things like Rapids, which speeds up data processing and machine learning, XGBoost for building predictive models, the HPC SDK, Modulus, even generative AI is being used now for feature engineering, refining models, generating predictions and forecasts.
Wow, so many different tools all working together. But you mentioned earlier that there can be a bottleneck in this whole process.
Yeah. You're only as fast as the slowest part of the
Yeah.
process, right?
Correct.
And historically, portfolio optimization, it's been computationally demanding. It's often been that bottleneck. So that's why this acceleration is so important. Speeding up optimization, it can really have a ripple effect, making the whole workflow more efficient.
Okay, so we see where optimization fits in. Now, let's hear from someone who actually does this for a living. Yigal Shirad from Cohen and Steers, he shares some really valuable insights. What was his main objective as a portfolio manager?
He put it pretty simply. Maximize alpha That's the return above the benchmark for a given level of risk. Now, how you define risk can vary. It might be just absolute volatility or relative volatility to a benchmark, which is also called tracking error, or you might use measures like value at risk or VAR.
So alpha is the name of the game, trying to beat the market. And he talked about different ways to generate alpha, right?
Yeah. He talked about bottom-up alpha, which comes from, in-depth analysis of individual securities, trying to find those hidden gems. And then there's top-down alpha, which is more about making those bigger bets on market trends, which regions, countries, or sectors are going to outperform, or maybe focusing on specific quantitative factors like value or growth. And he really stressed that you need to align your risk-taking with your firm's strengths. If your team's great at stock picking, you stick with maximizing that bottom-up alpha and you don't try to get too fancy with the top-down stuff.
So play to your strengths and avoid taking risks where you don't have an edge.
Exactly. And then on the risk management side, it's all about minimizing unintended risks, making sure you're not accidentally overexposed to a certain style or factor. And he also talked about breaking down that overall risk budget. Like if your tracking error budget is, say, 3%, so your portfolio can deviate from the benchmark by up to 3%, then you'd want to understand how much of that deviation is coming from your individual stock picks versus your overall market exposure.
Yeah, that makes sense. You want to make sure that your risk is coming from the decisions you're intentionally making. He also highlighted the importance of constraints. That might not sound as exciting as generating alpha, but it seems really crucial.
Oh, it's absolutely critical. He made the point that the results you get from optimization are highly sensitive to your assumptions, to your inputs. And constraints are what make those theoretical results actually work in the real world. They could be limits on how much you can invest in any one stock, restrictions on sector exposure, or maybe how much your portfolio can deviate from a benchmark. So without those constraints, you might get a mathematically optimal portfolio that's completely impractical, way too concentrated or just way too different from your investment goals.
So, constraints are like the guardrails that keep the optimization process grounded in reality.
Exactly. And he also talked about hedging strategies, which are, ways to use other instruments like derivatives to reduce the overall volatility and tracking error.
Yeah.
And he made a really interesting point about managing tracking portfolios. It's not just about minimizing the tracking error at one point in time. You also have to minimize drift, which is the tendency of the portfolio to deviate from the benchmark over time because of these underlying structural differences.
Drift, so like trying to sail to a specific destination, but the currents are constantly pushing you off course.
Precisely. And he mentioned how important co-integration is. That's where your hedging instruments and the underlying portfolio, they have a long-term relationship where their price movements tend to, come back to some kind of average. So that ensures the hedge stays effective over time. And he talked about the difference between managing long-only portfolios where you're mostly trying to beat a benchmark versus long-short portfolios where you're aiming for absolute returns, regardless of what the market does. And he pointed out that short portfolios, they have their own unique risks, like short squeezes, so you have to think about constraints that are tailored to those specific risks.
Really practical considerations there. He also talked about all the data and the technology involved. It sounds like a data-heavy field.
Oh, for sure. I mean, they use everything. Historical prices, company fundamentals, derivatives data, yield curves, credit spreads, macro indicators, even data on speculative positioning in the market. And then you have all the analytical tools, risk models, factor models, and then, of course, the optimization frameworks themselves. And he emphasized how important it is for all of this to work together seamlessly, the data and the tools.
A whole ecosystem of data and models working together. What were some of the key challenges he highlighted in the portfolio optimization process itself?
Well, he mentioned a few. First, the sensitivity to those inputs. Even small changes in your assumptions about, expected returns or correlations, it can lead to big differences in the optimal portfolio. So frameworks like Black Litterman, which lets you incorporate your own views, and using those constraints carefully, that helps. Then there's parameter instability. Things like correlations, alpha, even your confidence in those estimates, they can change over time, and it's hard to predict when. You also have to think about market structure, like how liquid are the assets, what's the impact going to be when you trade. And finally, he really stressed that in the real world, stability is often more important than theoretical optimality.
Stability over pure mathematical perfection. That makes a lot of sense in a dynamic market. Now, he also broke down how optimization might differ across different asset classes.
Yeah, that was really interesting. So with equities, he said that The optimization tends to be fairly stable.
Hmm.
You have to watch out for those tail events and remember that correlations can change. But mean variance optimization often works pretty well if you're diversified. Derivatives, though, they often require more focus on VAR because of those nonlinear payoffs. Commodities, they're really sensitive to specific events, so VAR is key there too because the price movements are often not normally distributed. Fixed income, it's nonlinear and prone to sudden regime shifts, so you often need a hybrid approach combining mean variance with VAR. And then currencies, they're very macro-driven, very event-driven. So again, a hybrid approach that includes VAR is often best, especially because you can get these really big, fast moves like when big currency trades unwind. So one size definitely doesn't fit all when it comes to asset classes.
Really important to tailor the approach to the specific assets you're dealing with. And what were his key practical takeaways for actually building and managing these portfolios?
Well, realistic constraints were really important. And he emphasized focusing on robustness, building a portfolio that performs well across a range of scenarios rather than just overfitting to the past. Stress testing, so seeing how your portfolio would hold up in those worst case scenarios, that's essential. And then you have dynamic model refinement. So, continuously updating your models to reflect how the market's changing. It's a constant process. And I liked how he summed it up. Portfolio optimization, it's both a science and an art.
Great insights into the real world challenges. Now let's shift gears a little and dig into the math that drives this. Peihan Huo from Cornell University, she walked us through some of the core concepts. So, like, how do you even quantify risk in a way that's actually useful?
Right, that's the first step. She talked about coherent risk measures. So these are basically the properties that a good measure of risk should have, things like translation and variance. So if you add cash to your portfolio, your risk should decrease by exactly that amount. Positive homogeneity, if you scale up your portfolio, the risk scales up proportionally. Monotonicity, a portfolio with higher returns, should always be considered less risky. And then, this is really important, sub-additivity. That's basically the mathematical way of saying that diversification works, that combining assets shouldn't increase your overall risk.
Sub-additivity, the mathematical backing for don't put all your eggs in one basket.
Exactly. And then she looked at some common risk measures to see how they stack up. Variance, or standard deviation, it's widely used, but it's not actually a coherent risk measure. One reason is it treats upside and downside volatility the same, and it also fails those translation and variance and monotonicity tests.
So just looking at how much an investment bounces around doesn't tell you the whole story about the real risk of losing money.
Right. And then there's value at risk, or VAR. It gives you an estimate of that maximum potential loss over a given time period with a certain level of confidence. Now, VAR does focus on that downside, but it's still not a coherent measure because in some cases it can violate that sub-additivity principle. So in theory, diversifying could actually increase your VAR.
Really? That seems counterintuitive to the whole idea of diversification.
It is, and that's where conditional value at risk comes in, also called expected shortfall, or CVR.
Yeah.
So it is a coherent risk measure, and it looks at the average loss in those worst-case scenarios, the ones beyond your VAR threshold. So instead of just looking at the threshold, it tells you what to expect on average if things go really bad.
Okay, so it's not just the dividing line, it's what you actually stand to lose on average if you cross that line. That seems more useful for risk management.
It is. And critically, CVR satisfies all those properties of a coherent risk measure, including some additivity. Now, the question becomes, how do you actually optimize a portfolio using CVR? There was a big breakthrough in 2000 when Rockefeller or Yassev, they figured out how to reformulate the CVR optimization problem so that it can be solved using linear programming. And that's important because computers are really good at solving linear programs.
So linear programming, that sounds like something that modern computing power can really handle.
Exactly. And by using a scenario-based approach, you consider all these different potential market scenarios, each with a probability, you can turn that CVR optimization problem into a linear program. And that's great because linear programs are generally some of the easiest optimization problems to solve computationally.
So you feed in all those possible future outcomes, and then the magic of linear programming helps you find the best portfolio allocation to minimize losses in those worst case scenarios.
That's it. And the beauty of this approach is that you can still build in those real-world constraints that we talked about earlier. Things like position limits, cash requirements, leverage limits, even a direct limit on the CVRR of the portfolio, and limits on how much you can change the portfolio. All of those practical things can still be included in that linear program.
So you're not just mathematically minimizing risk in some abstract sense. You're doing it while also respecting all the real-world limitations of managing a portfolio.
Exactly. And if you want to limit the number of different assets in the portfolio, maybe because of transaction costs or regulations, you can add what's called cardinality constraints. So you're basically saying, I only want to hold, this many different assets. And that turns it into a mixed integer linear program, or MILPA. But the good news is that both regular linear programs, LPs and MILPAs, they're generally the easiest types of optimization problems to solve.
Okay, so we've got the math. This shift to more robust risk measures like CVRR, and then the ability to express those complex optimization problems as these linear programs. Now, how does that connect to the GPUs we were talking about at the beginning? This is where Chris Mays and Pihan Hu really got into the details.
Right. So they started by talking about the history of linear programming methods, the simplex algorithms, primal and dual, then the newer interior point methods. And then they introduced the primal dual hybrid gradient method, or PDHG, which came about around 2011. And this one is particularly well suited for GPUs because it's really good at parallel processing.
What makes PDHG so good for GPUs?
Well, it's what's called a first-order iterative method. So basically, it does these relatively simple vector and matrix operations over and over again. And those kinds of operations, you can break them down into lots of independent tasks, which means you can do them all at the same time on a GPU with its thousands of cores. That's how you did those big speedups. However, basic PDHG, it can sometimes be a little slow to converge, meaning it takes a while to find the optimal solution. And that's where PDLP comes in, Primal Dual Linear Programming. This was developed at Google in 2021, and it builds on PDHG but adds some really smart improvements like averaging the results, using restart strategies, adjusting the step sizes, and scaling techniques. All of that makes it converge much faster.
So PDLP is like a souped-up, super efficient version of a GPU-friendly algorithm for solving these linear programs.
Yeah, exactly. And NVIDIA has a really optimized GPU implementation of PDLP in their QOpt library. Now, a big part of the work in these algorithms is doing these sparse matrix vector multiplications. So that's multiplying huge matrices that are mostly zeros with vectors. And this happens a lot in finance because you might have a huge universe of potential assets, but any one portfolio only holds a small fraction of them. So that leads to these sparse matrices and the optimization problem. And QOpt, it leverages NVIDIA's cusp-sparse library, which is designed specifically for doing these sparse matrix vector multiplications really fast on a GPU. And it also uses Thrust for parallel vector operations and RMM for managing memory on the GPU.
So those sparse matrices, they're really common in financial optimization, and that's why this specialized acceleration is so important.
Exactly. And it's important to understand that both sparse matrix vector multiplications and those vector operations, they're often what's called memory bound. So the speed is really limited by how fast you can move data into and out of the GPU's memory. And that's where the huge memory bandwidth of modern GPUs comes in. Like the H100 SXM with its 3.3 terabytes per second bandwidth, or even the B100 at around 8 terabytes per second. That's what really lets you take advantage of all those processing cores.
So it's all about moving that data as fast as possible to keep those cores fed.
Right. And that allows GPU-accelerated PDLP to really scale up to those massive problems that you see in finance. Millions of variables and constraints, but with most of the entries in the matrix being zeros.
And they actually showed how it compares to a leading CPU-based solver, right?
They did. They ran QOpt's PDLP on an H100 GPU and compared it to a multi-threaded CPU solver that was actually running a competition between 3 different CPU algorithms, primal simplex, dual simplex, and interior point, all in this publicly available test set called middleman LP fees. And the results showed significant speedups for QOpt on a lot of those problems. Now, one thing to note is that they used slightly different tolerances for convergence. They used a relative tolerance for PDLP and an absolute tolerance for the CPU solver. And that just highlights, one of the trade-offs to think about with GPU acceleration. You might be trading off a little bit of precision for a lot of speed.
But overall, the message is pretty clear. GPUs can really speed up these complex optimization problems. And they said that this technology is going to become even more accessible, right? They talked about NVIDIA QOpt.
Yeah, so QOpt is NVIDIA's library of GPU-accelerated optimization algorithms. And right now it supports mean CVAR optimization, which we talked about, that's the linear programming one, and also traditional mean variance optimization, which is a type of conic programming. And GPUs are really good at that too. And the big news is that QOpt is going open source soon, which means that anyone will be able to use it. That could be a game changer for the whole field of quantitative finance.
Open source GPU accelerated portfolio optimization. That could unlock a lot of innovation. And they also mentioned Qfolio, right?
Right. So Qfolio is a portfolio optimization tool that NVIDIA built specifically using QOpt. It's designed to be used by portfolio managers in their day-to-day work. And they showed some really impressive results for Qfolio running this realistic mean C-var problem. So it had about 10,800 constraints, 21,600 variables, representing 10,000 different market scenarios for a portfolio of 397 assets. And they ran it on an H200 GPU and saw speedups of 80x to 247x compared to a really good open source CPU solver running on an Intel Xeon Platinum 8480C processor. And those speedups, they were consistent across all these different historic market regimes.
Wow, those are massive speedups. I mean, what does that actually mean for someone who's managing portfolios every day?
Well, it means that doing things like repeated optimization, which is essential for testing and backtesting strategies, that becomes a whole lot faster. And they showed how you could use Qfolio to test all kinds of different rebalancing strategies really quickly, like rebalancing based on percentage changes in asset weights, or maybe based on how far they've drifted from their optimal allocation. You can test way more ideas and parameter settings in the same amount of time.
So instead of waiting hours or even days for a backtest to run, you can try a whole bunch of different things in a fraction of the time, like turbocharging the whole research process.
Exactly. And they even provided some hands-on labs to really show this in action. So there were 4 Jupyter notebooks. The first one showed how to run a typical portfolio optimization problem on a CPU, which they said could take a minute or two. And then the second notebook showed how to do the same thing using Qfolio on a GPU, and it took seconds.
Yeah.
So it was a really simple change to the code, but it made a huge difference, especially for those larger, more complex problems.
That's a powerful way to show the impact.
Definitely. And then the third notebook was all about back testing, so seeing how an optimized portfolio would have performed historically. They compared a mean CVAR portfolio to a simple equal weight portfolio and used historical data and kernel density estimation to simulate those different market scenarios. And the final notebook covered more advanced topics like designing and testing those different rebalancing strategies that we talked about. And they pointed out that with GPUs, you can actually test so many different strategies that it becomes a hyperparameter tuning problem. So the key takeaway from those notebooks was that GPUs consistently led to huge reductions in solver time across all kinds of different market conditions without sacrificing the quality of the optimization results.
Sounds like those labs really brought all this theory to life. So as we wrap up, what are the key things for our listeners to remember about this whole world of accelerated portfolio optimization?
I think the most important takeaway is that portfolio optimization has come a long way. From those early ideas to the sophisticated risk-return frameworks we use today. And we talked about those important mathematical concepts, especially coherent risk measures like CVRR, and we saw the real-world challenges that portfolio managers face. But the big story here is that GPUs are changing the game. They can solve these really complex optimization problems so much faster, and that lets you test strategies more thoroughly, which means you can potentially build more dynamic, more robust portfolios.
I agree. For me, the big aha moment was realizing that something that used to be a huge bottleneck, it can now be done so quickly. And that means you can analyze things more deeply, test more ideas, and ultimately make better investment decisions.
And with QOpt going open source, that's just going to accelerate the innovation in quantitative finance.
Yeah, that's really exciting. So what would be a good next step for our listeners if they want to learn more?
Well, I definitely recommend digging deeper into those coherent risk measures and CVR. Understand why they're important, what makes them different, and then learning a little bit about how linear programming works and how GPUs can accelerate it. That's really valuable too. And if you want to get really technical, check out those NVIDIA libraries, CUSPARS, Thrust, RMM. Those are great resources.
Great suggestions. And to leave you with one last thought, in this world where markets are so complex and constantly changing, how is this new computational power going to change the world of investment management? How will it change the strategies that people use to deal with uncertainty and try to generate returns? That's something to think about. Thanks for joining us for this deep dive.